Welcome, everyone. Let's cut right through the noise on the timeline today and look at the verified data. Right now, we are witnessing one of the most intense macro stress tests in Bitcoin's history. Over the last few weeks, the market has been hammered by the escalating geopolitical crisis in the Middle East. When the threat of US and Iranian military action peaked, pushing oil past $110 a barrel and causing panic in traditional equities, we saw Bitcoin momentarily break down, sliding into the $67,000 range as over $240 million in long positions were liquidated. But here is where the narrative flips, and why you need to pay attention to what the data is actually telling us. Following the announcement of a temporary 5-day diplomatic ceasefire, Bitcoin didn't just recover, it aggressively ripped back above $70,400. During this entire month of global uncertainty, while traditional safe havens like gold dropped and the S&P 500 bled, Bitcoin actually demonstrated relative strength, gaining around 7% and vastly outperforming legacy assets. It is actively proving its thesis as a borderless, non-sovereign hedge. But the price action is only half the story. While retail traders are watching the 1-minute charts, institutions are completely restructuring the plumbing of the crypto market. I want to highlight 3 massive verified updates that have fundamentally shifted the landscape just this week. Number 1, the Wall Street floodgates are open. Yesterday, the New York Stock Exchange, specifically NYSE Arca and NYSE American, officially scrapped the 25,000 contract position limit for Bitcoin ETF options. This means the artificial ceiling on institutional trading for ETFs like IBIT and FBTC is gone. TradFi whales and hedge funds can now trade up to 250,000 contracts and execute massive bespoke option strategies. Wall Street is no longer just testing the waters, they are building deep-sea infrastructure. Number 2, corporate accumulation is accelerating. If you thought corporate adoption was slowing down, look at the latest SEC 8K filings. Strategy Inc., the entity formerly known as MicroStrategy, just completed another monstrous acquisition. Between March 9th and March 15th, they purchased an additional 22,337 Bitcoin for $1.57 billion. They now hold a staggering 761.68 BTC. The smart money is not selling the geopolitical dip. They are buying it with billions of dollars. Number 3, regulatory clarity is here. We finally got the landmark ruling we have been fighting for. In a joint action, the SEC and the CFTC officially classified Bitcoin, along with Ethereum, Solana, and XRP, as digital commodities, not securities. The dark cloud of regulatory ambiguity that has suppressed this industry for years is officially breaking. However, as researchers and builders in the Web3 space, our job is to stay grounded in reality, not just pure hopium. Do not let the rapid bounce back above $70,000 blind you to the underlying market mechanics. The derivatives market is flashing warning signs. Futures premiums remain low, and options pricing shows that this recent rally was largely a relief bounce driven by short squeezes, and a shift back to risk-on assets rather than pure organic spot demand. Furthermore, on-chain metrics show that smart money has actually been distributing into this liquidity. The bottom line? The long-term 4-year cyclical structure remains violently bullish. The institutional rails are built, the regulatory war is turning in our favor, and Bitcoin is surviving a massive geopolitical stress test. But in the short term, expect brutal volatility. Manage your risk, ignore the engagement farmers on X, and watch the verified on-chain data. Thank you.